Great to have you on, Dan. It's really pleased to see you again. Last time we spoke. In fact, we met at the AFEP conference when we were talking about liquidity risk management in payment services. We'll probably spend a little bit of time on that. But kind of, why don't you introduce yourself, and maybe if you've got a funny story, tell that as well, and then we'll kind of get into it.
Okay, well, good to see you again. And that was a very interesting conference. Liquidity at that point in time was a very topical subject, and I think it always will continue to be, because at the end of the day, if you don't have a well-financed business, it constrains growth, and you can find yourself in tricky waters. So, yeah, who am I? I'm Danny Kinnear. I worked in banking for over 25 years, primarily supporting clients for their foreign exchange needs. So, corporate FX sales guy, but also provided liquidity to banks and many of the non-bank FX providers that have emerged over the years. So, great experiences, got to see many amazing builders of businesses. Really encouraged to see some of them kind of IPO and get acquired, or in the process of being acquired. It's been a good ride. I left banking a few years ago, and now I continue to keep myself occupied in the FX space in three ways. I invest in new startup businesses, one example of which is a challenger fintech called Glyde. Really impressed with what they're doing. I also like to help other growing businesses by providing strategic advice. That may be around revenue generation, what new products they can add, or it could be helping them to access new liquidity, either debt facilities or additional trading lines from maybe some of the banks that I once worked for. And then the third way that I keep myself engaged in this space is by actually holding myself out as a newbie entrepreneur. I run my own FX platform.
Excellent.
This works with a panel of providers, and what it has given me is a really good insight into the strengths of the various players out there, because whilst they may all look equal, they all have their own USPs. And so if you have a client who has, let's say, emerging market exposures, then there are some players who are better to work with than others. Similarly, if you're a fund that needs long-dated hedging lines, again, there are some players who are more receptive to that business and could be more competitive. So for me, it enables me to stay in touch with the evolving market space. And hey, I went into banking because I wanted to make money, and it gives me an opportunity to still earn.
Yeah, great. And actually, so in keeping with other episodes, we don't tell the guest the title of the episode until they're here. And the title of this episode, Danny, is going to be "Why Can't We Just Make Money?"
Hey.
Right? So how great we captured. You looked at the camera for the facial expression, but the reason, so it's a funny title. Obviously, we've got to be very cautious about kind of how we present ourselves after saying that. But when we kind of set up this this idea and this experiment of doing this Not Another Risk podcast, we very much wanted to bring different perspectives on risk management, and so we're really pleased to kind of have someone on who kind of has a more of a kind of front office lean on things, and I'm going to actively encourage you to kind of bring good and bad stories about obviously redacted stories about your experiences with control functions. And I guess the first question I want to kind of ask you is kind of why do you think risk and compliance departments have got a reputation for saying no?
Because that's their job. But let's expand on that, because if you left it there, that would be unfair.
Yeah.
No, they're very integral to building a sustainable business. Ultimately, what we want, if we're creating shareholder value, we want to have something that is sustainable, and ultimately you can attach a high PE multiple on and sell, right? So to do that, you need to actually have a solid business, a business that lasts. And to do that, you need to have a well-documented business, you need to have processes which are fully understood. In this industry, which is a regulated industry, you need to comply with the kind of the regulations. And me, I'm a sales guy, so you brought the right person in to talk about why can't we just make money, because that's my objective as a sales guy. I will be up to speed with what the regulatory requirements are, but not in the same way as my compliance professionals. Okay? And how I view them and why they are so important and how they actually help us build sustainable businesses is because they will protect me from doing things wrong.
Yeah.
Or and let's expand that, from exposing the institution to something that could prove to be very damaging either at an economic level or from a reputational level.
Yeah. So risk is good. Too much risk, well, could be business ending. I mean,
risk is good.
Yeah.
I mean, let's. My career's primarily been in banks, and banks are in the business of managing, transforming, taking risk. There's nothing wrong about taking a risk, but what you need to do is you need to understand it, you need to price it, and you need to know how you can offlay it. Okay, so sales, trading will know exactly how to do that in a certain degree, but then other areas of the bank, control functions, legal, compliance, credit, risk, operations, they will bring to bear their ninja-like skills to ensure that the business continues to work smoothly.
So really, they every so often they just simply have to say no. Would you kind of, when you as a salesperson, when you hear that, how would you like them to perhaps deliver that message? You understand that sometimes no is going to be the answer, but how would you have them maybe frame it in a different way?
We're not children.
No.
Right, we're not children, so a parental-child situation, a parent will say to a child, no. And depending on the age of the child, may not give any explanation. As a child gets older and can comprehend and can understand, the parent, if they're parenting well, should provide an explanation, because then the child has understanding and doesn't need to be told no a second time. Bringing it to the business world, if compliance or if credit said no, I'd like to understand why.
Yep.
What is their concern? Because I shouldn't be looking to do something that's wrong. Okay?
Yep.
If I'm looking to do something, and let's use credit as an example, if I'm looking to do something that requires a certain size line, if it's totally outside of what that client's underlying business can support, then I shouldn't be making that request. I mean, that's just silly. Okay? But if it is within what I believe their debt capacity to be, then it's a legitimate request. Now, if credit say no, that should be a surprise to me. So I need to understand what has changed, what's happened that has tightened their appetite. It could be because there's been losses within the sector that I'm unaware of.
Yep.
It could be of capital constraints. There could be a number of reasons. But if I understand what the reason is for saying no, then me as a kind of a solutions guy can work internally to see if I can bring them on side. Now, bringing them on side may be looking for a smaller size trade, something that does fit within their appetite where they can say yes. So let's figure out where that appetite is. So so we reverse it from it just being a binary, no, you can't do business, to, okay, well, what business can we do?
Yeah.
Or, let's give examples. So there was a well-known, very large travel company that had for many times got into trouble and almost got into default situations. And one of the times when we had just got them on board to a bank that I had recently joined, so they were a very good client to win, they hit troubles once again. And of their 21 banks, we were the 21st that were in their group, 18 pooled lines. The two main funders kept lines open, and we kept lines open. So much so that, one, we did good business because we were able to keep trading with them, but two, when they came out of problems, we were very well regarded and saw good deal flow from them thereafter. Now, how did we achieve staying in when so many pulled out?
Well, that's what I was going to say, because how did you if everyone else was pulling out, how did you get yourself comfortable that you could stay in?
Let's address that. So there was a high motivation that I had, which was, I don't have many clients. I can't afford to lose this revenue contributor, so I really need to find a way to keep us in the game. Highly motivated. Yeah. You know, that probably wasn't the same at those other 18 banks, right? They had many other clients. So what? They're not incentivized to fight for it. I was. So
incentives are important.
So the incentive was there, but then an understanding of what credit's issues were. And it was a liquidity issue. And the question then was, well, how much liquidity do they have? At what point in time do we feel comfortable that they're still going to be there? Okay, they're in a high cycle of cash at the moment. Okay, so they're not going to run out of liquidity. Up to what point? Let's do some deep analysis. Okay, we feel they're good until the 30th of September. All right, so they're not going to go bust before the 30th of September. Well, why don't we just do trades out to the 30th of September and not beyond?
So working collaboratively, sales and risk or compliance, or however, or in this case, your credit team, sales and credit team working together.
Credit, complemented and supported very actively by the CVA trading desk, which is a desk which is often viewed as a tax by many people, but can be a huge enabler for business because they truly know how to run risk and how to transfer risk. So that's how we managed to retain that client, supporting them for a time when many other people went away, which fortunately they survived during that period and then had many more years of actively trading across the street, of which we probably got a disproportionate share of their wallet because we had been recognised as supporting them when others didn't.
I mean, I always found the idea of that kind of CVA desk as kind of an interesting one, because he took an accounting term, credit valuation adjustment, and then turned it into a revenue stream. It's really good idea, isn't it?
And a big revenue stream for certain desks.
Yeah, for certain desks.
Having worked across banks, having the same clients doing the same trades, and seeing, I'll give you an example. Doesn't matter what the trade is or the client is, but having one CVA desk saying I've got to mark up the price by 20k to pay them the 20k CVA charge, and then going to another bank where it's like $500, just because of different models, different costs of capital, or just different chances.
Yeah, there we go. So let's talk a little bit about, if you like, the other side of that equation. So let's talk about, if you like, some of the customers of the banks and the liquidity providers. Talking a little bit more about kind of payment services and that kind of FX, that FX business. So what do you think? What do you think if you could kind of wave a magic wand and change one thing about that kind of payment services FX sector to make it, let's say, more sales friendly? What would you change? We're going to ask a slightly different question in a minute, but let's stick with that one for a minute.
You're kind of suggesting that there's something wrong.
Well, I did say to a couple of episodes ago that I'm going to bring someone on and actively encourage them to kind of to see if I could uncover something that perhaps they thought was wrong.
Okay, so you've got at the moment you've got a very disparate. You don't have a level playing field for salespeople at different institutions with regard to remuneration. Okay, so I think if users of these services, and let's just talk about corporates, okay? If corporates understood how if they understood the cost structure of different platforms, and a large part of the cost structure is the remuneration paid to their sales coverage. If they understood how that varied across different institutions, from investment banks that have a very different payout structure to commercial banks, to non-bank providers, agency brokers, match principal brokers, to fintechs, to the various players out there. If they understood how that worked, then they probably could get better value. This is one of the reasons why some of the fintechs can offer cheaper kind of FX payment services than some of the banks, not just because of the operational kind of technology piece, but because of how the salespeople are remunerated. Let's just exaggerate to give an example. You know, at a bank, your total comp may be 5% of your revenue generation.
Yeah.
Okay. Whereas at a broker, right, you might get 80% of your
I'm sure there's lots of brokers like that deal.
Right, so I'm exaggerating. I'm giving a really low and a really high. But what that means is, if you can do a spot trade with either or, and the salesperson who's covering you is thinking, I want to make $1,000 in my bonus from this trade, right? The person who's getting paid a much lower payout needs to mark you up a lot more.
Yeah. Which
means you're paying a less attractive rate than if you're doing it through a platform where the numbers are different.
So I mean, did I hear that? Did I hear that correctly? And then challenge me if I haven't heard that. If I get this wrong. So are you suggesting that the more rules you put around remuneration to kind of push down the compensation of sales staff, the less competitive the rate comes, and therefore actually the more rules you throw into the pot, the less value the corporate gets?
It's more complicated than that, because I think this holds true in certain segments of the market, less so when you when you stretch it across the entire market. Because obviously, if a salesperson at a large international bank, what goes into their total comp, their career progression, they may only sit on an FX desk for a few years of their career and then look to move into investment banking or debt capital markets or something else. So there's different motivators than if you're just a pure play, you live or die as a broker on this quarter's revenue target, right? So I think you asked me what's wrong. Poor incentives drive poor behaviours. I think people who provide a good service to their clients in any industry, in FX, should be paid well for that. I think if you underpay people, or if you have mechanisms in place which pay them out only for the first year and then they lose bonuses for that client and they find new clients, can be very destructive for the kind of long-term equity value, because ultimately that broker is incentivized to leave and take his clients away. If they only get paid out for the first year or first 2 years, or on a decreasing scale. Or
if you've got a particularly aggressive client that's really kind of pushing you down on rates, you might not show them the best deals or the best prices. Or do you think it works both ways, both for the employer and the client?
Salespeople will always look to close a deal, right? Because it's better to make something rather than nothing. Unless it consumes resource that can't be deployed elsewhere. So credit lines, right? So if you're rationed on credit, then you're not going to be as incentivized to tie up your lines by doing less remunerative business, either at the firm level or at the sales coverage level. So you could have a situation where the salesperson, if they're not fully aligned with the business, they will print trades that pay them out well today, but tie up the firm's liquidity in the long term. So there needs to be management between the firm and salespeople, ensure that people know the value, the true value of the business they're building.
So I guess investing a bit in the again, I'm going to use the word nexus. I love that word. In kind of your credit lines, what liquidity risks that bring to the firm versus the products that you're selling to your clients. Actually investing some time and money understanding those relationships actually can deliver long-term value to the firm and to its clients, and ultimately to the salespeople if they are engaged in it and understand how that works as well.
Yeah, most definitely. I mean, the more people are aware of how their overall business works, you know, if you touch somebody there, then something happens here, then you're going to have a better, more resilient operation.
All right. So let's talk a little bit about conducting business responsibly. In terms of, you know, we can talk about consumer duty or treating customers fairly, and you know these sorts of ideas. But let's kind of put the regulations aside for a minute and just think about you as a salesperson and as a business owner, entrepreneur. You know, you want to bring create value through building solid client relationships. So just from a common sense perspective, you know, what would be the 3 or 4 things that you would say, look, you know, here are some bright lines. You know, these are the things we do. These are things that we're never going to do.
Okay, but everything starts with understanding your client. What business are they in? What exposures do they face? How do they manage those exposures? What is their psychology? So if you understand what the situation is, then that's where, you know, a good sales coverage professional, a good firm will then bring forth their expertise, their secret sauce, which is hopefully providing that client with what it is that client truly needs. So if you do that, if you're servicing your clients in a way that helps them build their businesses, reduce their risk, grow their revenues, then you will have a very, very good relationship. Where it begins to go wrong is when you may, and actually, I mean, this rarely happens from sales pushing clients into overexposing themselves. Yeah. That's a fallacy. I mean, some of the big kind of defaults that I've seen where people have lost money, brokers, banks have lost money, around the world in various kind of situations. It's not being because a institution has oversold, overhedged a client. It's because the client has overhedged themselves. Yeah. Often because they've blinded themselves to the possibility that an event could arise.
Okay. So let's explain that a little bit.
Yeah, because that sounds a bit academic. So let's give you a real example. So post financial crash in Poland, you had huge losses because, quite simply, what happened was prior to that time, the universal thought amongst corporates in Poland was that, you know, eventually Poland was going to enter the EU and it's going to enter the euro. And so if you looked at all charts of euro zloty, it was zloty strengthening. So essentially on the y-axis, euro zloty was getting lower and lower and lower. Okay. So what that meant was the Polish companies who are manufacturing and selling into euro land receiving euros. Yep. That means on a forward basis, they're getting, you know, they wanted to fix today their euros forward so they can get more zlotys because they thought euro zlotys is going lower and lower. And if they hadn't done that, then they would have got less zloty for their euros. Yeah. Step 1. Step 2 is they suddenly became aware that, you can use leverage products so you can get an even better rate. Yeah. Okay, which is good. So rather than selling at whatever it was, I don't know, 418, they can sell euros at 425. That's fine because it's just going to go lower, and they would have got a bit of a bonus. So that's leveraging on a trade, which isn't an issue, right? Because when I was sent out there and I looked at the situation to try and see how we could fix clients who were in negative positions, once it turned out that it wasn't a one-way bet, and suddenly euro zloty spiked higher, which is where it all went wrong. You suddenly realise that, oh my gosh, this client, they hadn't over-hedged themselves with us. They told us they had to do $1 million a month, and we did a maximum of $1 million a month. But they did the same thing with 6 other banks.
Yeah.
So they leveraged themselves across counterparties, which no single counterparty would have been aware that they had done that. And that's something which is very hard to fix. You can fix a client who's overhedged themselves just in a particular moment in time with you, because you can, if they're credit worthy enough, you can extend and blend and do structures that stretch it out and help work them through it. But if they've magnified that across multiple providers, it's catastrophic. And we saw that in Poland in 2008-9. We saw that in Taiwan. We saw that with Swissy DPEG.
Yep.
We saw that when with COVID lockdown, when your dollar suddenly kind of went crazy, and there was a lot of non-bank providers who suffered certain losses with an Italian corporate who had employed kind of similar strategy.
Yeah, and I think we spoke about that. I think we spoke about that last time. So the last time we met at the AFET. At the AFET conference. Yeah. So one of the things that kind of I want to again kind of talk about is in the spirit of kind of this healthy tension between sales or front office staff and support and control staff. Where do you see the areas where there is the most value in collaboration between those two groups of people in a firm?
Okay, so they should all work together as one.
We'll assume that.
Okay. Let me come at it in a slightly different way. The bit of my background and how I evolved my thinking, which turned me into, I think, a better manager. So this may be useful for other people on their salesman's journeys from sales guy to running a business. So once upon a time, I was just focused on generating revenue, and I thought, that's my task. I do that, done. And I viewed some of the control functions, which again I summarize as legal, compliance, risk, credit, as breaks.
Could I add operations?
And operations, yes. Yeah. As breaks on that.
Yeah.
Okay. And that frustrated me, right? Because I was too inexperienced to really kind of get it. As I became a little bit more alert, then I kind of realized that, look, these people, they're all tasked with building a healthy business. And in fact, some of them are actually, in the label on their name is, credit advisory, compliance advisory. Yeah. They're there to advise us on how to build healthy, sustainable businesses. And once I had that kind of epiphany moment, and truly apologies to anybody in control functions who I interacted with before that epiphany moment, I must have been terrible to work with.
What, surly, rude and arrogant, perhaps?
Perhaps. But once I had that epiphany moment, then suddenly what you have is you have a great collaborative, or you have an opportunity to have a great collaborative working relationship, because what you're doing is you're building a business, and that's why people enter these industries, right, and don't become dentists.
Although dentists have pretty successful businesses too. Licensed to print money.
That was a bad example, because they have excellent businesses. But somebody who's my uncles and aunts were teachers, so somebody who goes into teaching, right? They're there because they may have done business degrees, law degrees, whatever. They've gone in finance, economics. They've gone in because they're interested in business, and you're there saying, look, we're at the front end of the business. We're speaking to clients or trying to get into new markets, trying to bring new products, bring them out so that we can distribute, market, generate more income. This is what we're trying to do, because we think there's money to be made. We know if we do it right, we generate that revenue. But what we don't want to do is have something come on our back and bite us in the arse. We don't want to have a credit event. Yeah. Right. We don't want to have somebody suing us, right, for mis-selling. Yeah. Years down the line. So we want to do things right. Yeah. truly, we want to do things right. And I say this because one of the biggest tensions I had with legal was how we produce term sheets. They wanted it to be so legalese that your layperson wouldn't understand what they were reading.
Yeah.
And what I wanted was something that a layperson could understand. Okay, so
I mean, that's one of the core components of consumer duty, right? I know perhaps we're talking about corporate term sheets, but actually having, we've talked about plain English, so but how do you solve that problem? Because legalese, well, I don't know, well, it has a place. It's necessary.
yeah, so you do both.
Yeah.
Right. So you do both. So you have. I mean, the solution there was, okay. So you've got documentation at various stages. You've got you've got marketing.
Yeah.
Information, which can be very layman-like. You can have scenario analysis. You can show, how things can pan out.
Diagrams with the payoff
diagrams,
profiles on structured products.
Exactly.
Yeah.
And spot ladders that
Yeah.
show you what the mark to market would be at different levels across different dates. You can present all that in a way which is very accessible. You then have term sheets, which will be a bit more formal, but you can still incorporate some of that. Or in fact, your email marketing, you could have the lay language with the term sheet.
Yeah. And
then of course you've got the trade confirmation, which.
So what does this mean in plain English?
Yeah.
Or key terms you must read and understand.
And me, I always had positives in green, bold and font, negatives in red, bold and font. It's like equal measure. Make it really clear. Do not shy away from what the risks are. And this is where, like a ratio forward, which could mean, if it's in your favour, you're covered on one unit. If it's, if it's gone too, if it's protecting you, it's protecting you in one unit. If it's obligating you, it's obligating you in 2 units of currency. That could either be viewed as something that overhedges you, bad, or it could be viewed as something that underhedges you. Yeah.
So you move outside. You move outside a certain window, and suddenly you find yourself having to settle double the amount.
Yeah. So the reason why I'm using this example is because sometimes people may only focus on one risk without recognising that there's actually a secondary risk as well.
Yeah.
And so what I would do is I want to be really clear. I want to ensure that, and I would urge and hope that all kind of client coverage people don't be afraid to highlight what the risks are, because the people that you're covering are business people, right? Their whole businesses, their whole job is kind of risk in a way.
Well, yeah. I mean, I'm really pleased you said that.
This.
Your whole job is risk management because it is. It's not the risk person manages risk. It's we're in business to manage risk.
Everybody in business has risks, right? If you're covering fashion retailers, the fashion retailer, I mean, the big risk they got is whether or not they're going to select the right fashion for autumn, winter, spring, summer.
Yeah, autumnal colours.
Right? Some businesses are great, like Zara. They can turn things around really quickly if stuff isn't selling in blue, but it's selling in red, and then they just quickly turn around and start making more red stuff. But other businesses have longer lead time.
Yeah.
So they're all very aware of the risks they face. So they get that language, and if you're just clear and you communicate it, and you coming back to what I said earlier on, you understand your client, you understand what their exposure is, how they manage it, and what their psychology is.
So if I can just pause for a second, so sounds like what we're talking about is KYC, know your client. That you're describing KYC, and actually you're describing it from a sales point of view as a kind of as from a salesperson, I need to know my client. I need to understand my client, and so whereas sometimes when we think about KYC, perhaps we confuse it with CDD, and we say, "Oh, KYC, that's not really my job. Go and talk to compliance." But you're advocating salespeople need to really know their client. I mean, I happen to agree with you.
Because otherwise, how are you going to differentiate yourself from other salespeople who don't? So you really need to know it. And if you're doing more complex products, then you should be documenting this at the outset. You should be documenting, what products, what tenors, what notional sizes are appropriate for this client, given the information that they've told you, given your understanding of their business, because that will
Suitability assessment.
Yeah, exactly. Exactly. That will that will reduce the potential risk of future litigation if something goes wrong.
And also, you have a customer that's getting what they actually need, rather than perhaps what you want to sell them. I'm sorry, what one wants to sell. I'm not for a minute suggesting you would do that, but and so it sounds like actually this kind of, if you can take some of these, if you like, what are traditionally maybe referred to as regulatory compliance tasks, you can frame them slightly differently. Put them in front of a salesperson or front office, and actually help them understand why it's important, and if you like, coach them to be a better salesperson and make more money.
Short-term benefit is that it enables the salespeople to do exactly that, to be better salespeople, because they've paused, they've taken a moment to understand their client, which means they should be. It should be an easier task for them to sell to client. Longer term or medium term, it helps the organisation, because what you're doing essentially is you're capturing data on your client set. You're capturing really rich data.
Yeah.
So you're institutionalising that client, so that if the salesperson leaves, you can pick up, and the probability of retaining that business is so much higher. That's important, because that drives shareholder value.
Yeah.
And then longer term, you're mitigating the risk of a future unsatisfied client, because remember, these are corporates, right? So you may have had a CFO who loved doing all of these types of trades.
Yeah.
They leave, new CFO comes in, the business isn't doing too well, and they think, maybe we can wiggle out of some liabilities by saying this was missold.
Yeah. Okay.
But
yeah,
that rarely happens in FX, because FX is a short-dated asset class, right? And typically the trades roll off before businesses get in trouble. Typically.
We're going to talk a little bit more about structured products and long-dated instruments in a sec. I hope we'll have time for that. I hope we'll have time for that.
Anybody who knows me knows that's my area of interest. But you don't want to be distracted by the possibility that such claims may be made against you, right? So if you can just knock them on the head really quickly, or rather, actually, because I've not really seen too many of those issues, it's more about defending the sales guy, because in fact, I do want to share this with you, because this is actually what's more likely to happen, and I expect there are many salespeople who may have encountered this.
So hopefully you can hold on to that thread. This sounds really interesting, and so I kind of want to set it up and build it up. So please tell me.
Okay, so there'll be situations like this. Okay, often and I'm talking mainly from banks, but this will be true of non-banks as well. There will be the salespeople are close to the clients. They'll put on trades. Those trades may work really well for a client, or they may evolve and have big negative mark-to-markets. So much so that even though there's no issue, the client hasn't bemoaned anything, control functions may begin to get concerned. Credit in the first instance, because they're seeing a big mark-to-market, and they're like, what's happening
and
here?
An associated margin call by the liquidity provider?
Exactly, yes. Especially from the liquidity provider, if it's a non-bank who backs out the risk, or if it's a margin call that's being made on the client, which is coming late, there may be nervousness at the institutional level.
Yeah.
Now remember, the person closest to the client is the salesperson. The control functions, who may be getting nervous, may then kind of start questioning what's happening. Management may start questioning what's happening. Is this something that we need to be worried about? If you are in a culture where there's a perception that salespeople just want to make money and they're not being good stewards for the business, then a tension can arise where a salesperson may feel under pressure, or if they want to restructure the position, which is often where these conversations arise, especially in banks. You may have to go to a non-standard transactional committee or a rep risk committee if it's sizable to get full sign off, it can be quite testy, right? Because you're speaking.
We don't want to lose any of this. Lean into the lean into the mic.
You're speaking to a cohort who. I mean, let's face it, they've got different incentives, right? So the control functions are like the goalie, okay, and the salespeople are like the striker. In that striker, kind of a terrible game, but if they score in the last minute, they're heroes. Whereas the control functions, they can be saving every single shot on goal and be superstars. But if one goes in, they're the enemy, and that's unfair because economically their incentives are different. Okay, so they're really criticised if something goes through, even if it wasn't something that they could have done anything about. And if you
my mates are going to rinse me if I attempt to go into any sort of football analogy, so I'm just going to go with it and take your word with it. I was about to talk about defence strategies, but then I can imagine people saying, Simon, you know nothing about football.
We lose half the crowd.
Well, I mean, I'm lost already.
Same
right?
here.
But sorry, carry on.
So they really don't. They're not necessarily incentivized to take risk in the same way as sales, and therefore it's right that they're cautious, and it's right that things should be socialized and things should be discussed. But the reason why I'm using this example is that often there will be times where client positions can become quite stressed, and where remedial action that you're looking to do may necessitate kind of internal sign-off from a range of internal stakeholders. And you need to, they need to be confident in your understanding of the client. They need to be confident in your motivations for what you're doing, like you're doing business properly, not just because you're wanting to clip a bigger bonus. And they, the more information, the more you can bring them in as partners, the more likely you are to have good sustainable business. And I've seen this go really badly for certain institutions. I mean, I've seen this go calamitously for one organisation who lost $500 million plus because of having a breakdown in sales ability to communicate with the control functions.
Okay, so let's spend a little bit of time about talking about structured derivatives or just FX options in payment services. So there's a number of payment services firms. They offer FX options in the appropriate way with the appropriate permissions. But if you were talking to kind of one of your a company that perhaps you're mentoring that is doing these products, or if you decided I'm going to start a new business, another firm myself, and we're going to really kind of lean into corporate clients and structured FX. What are the 5 things that you would have to hand built before you grew that book?
Okay. So structured forward, structured products. These primarily are kind of credit products. Okay.
Yeah.
So that's a differentiation from if a client's just paying upfront premium for an option. That's a very low risk product.
Okay, so I'll be
that's
more
a super product, but on the structured side.
So I'll be more precise with my question. I'm talking about I'm talking about our favourite subject, things like TAFs.
Yeah. So exactly. Okay. And this will be true if it's a non-bank or a bank. Okay. Because there was a while back where not everybody was offering that product. So, number one, I'd want to be able to price it myself.
Yeah. So a proper valuation model.
Proper valuation model, both me and the sales desk, so that I know what the real price is.
Yep.
So that I can be appropriate in my margining.
Yeah.
And that's important because if I'm a distributor, so if I'm a non-banks are distributors, right?
Yep.
And many banks are distributors. Only a few banks are true wholesalers taking the risk. What I mean by that is, if you're doing a trade with your client as a distributor, then you're backing the risk out to somebody. You're often backing it out to another distributor who's backing it out to a wholesaler.
Yeah, and there's a whole value chain behind
that. Yeah. Right? Everybody's marking it up. So if I'm going to put on 10 basis points of markup, I need to be able to price it so that I know that my liquidity provider, what they're taking. So that if the most it could be is 10 basis points and my liquidity provider is taking 2, then, you know, then I know what the math is.
Yeah.
If my liquidity provider is taking 20 and the most I can actually do with my client is 10, then it ain't going to work.
Yeah.
Right, with that liquidity
So
provider.
proper valuation.
So
model.
I need to be able to valuate it from the sales desk perspective, but then you also need to be able to value it from a internal perspective, because the second element that you need is you need to ensure that you can fund those positions.
Yep.
Okay, so that's the whole liquidity management piece, because in the corporate space, it's an asymmetric business when it comes to liquidity management. Your liquidity providers, the people who you're backing the risk out, they're going to want, but very unlikely going to give you credit.
Yeah.
They're going to want initial margin to cover the jump risk when you put the trade on, plus you're working on a zero threshold CSA.
Yeah.
Okay. Whereas the clients who you're doing those products with, which are primarily used for liability risk management purposes, right, as hedges, whether or not they are properly hedges, we can debate that.
But maybe not today.
But maybe not today. Just the way how the market is structured, the clients want clean lines.
Yeah, and also I kind of hate this term, riskless principle. I mean, people don't use that quite so much. But I even don't really like the idea of match principle, because it gives this idea that there's no risk. When actually, even if you are indulging in back-to-back trading, you know, because of these asymmetric terms, you can create quite large liquidity risk impacts.
Yeah, it's huge, and they can, you know, it's liquidity which kills you, right?
Yeah.
So number one, being able to price it so that you can have intelligent conversations with clients, structuring the right solution, priced appropriately. Number two, so you can actually understand how you're going to fund it.
Yeah. So we've got valuation model, liquidity risk management framework.
Yeah. So those are 1 and 2.
Yeah.
Number 3, you need to have, and this comes back to working with your key stakeholders, compliance, legal, ops, you know, credit risk. You need to ensure that, you know, this business that you're now offering is properly documented. You know what is in scope, what's out of scope, what kind of approvals you need, what escalation.
So some sort of mandate process, so that all the salespeople understand the boundaries and the boundaries within which they can operate for the product.
Yeah, because that will protect them.
Yeah.
Because if they operate within those boundaries and something goes wrong, well then it's not them, it's the model that's wrong. Excuse me.
Yeah. Okay. take a drink.
So that's really let's call it a compliance framework. You know, a kind of maybe kind of like guidelines.
I mean, I'd like to call it the wider aspects of risk management. So what could we call it? So we've got valuation model, liquidity risk management, and then maybe I don't know, sort of sales mandate.
Yeah, but this is about sales mandate or kind of ops model, and this is this is where maybe we both come in, right?
Yeah.
Because you know we've kind of produced this kind of target operating model for how that business is going to be conducted, because it is a different business to a spot business, right? Because spot business is not a credit business. Okay, you've got you know daylight limits, but you know it's not a credit business. It is a more regulated business, and how you deal with your clients, professional, you know, retail, however you categorize them. That's going to have. It's kind of strange because I
well, the payment aspect of it is, but,
yeah.
But let's not get into the kind of the perimeter discussion.
I think on the compliance piece, my view is just treat everybody like a bloody retail client. Give everybody the same protections, even if they're eligible counterparty, and then you're golden. Right?
Okay, so we got distracted a little bit. Maybe we'll go back to what 4 and 5.
I put that as 4. The 4.
Okay, so some
sort
sort
of the
of
compliance.
Okay, that TCF or treating customers fairly kind of
because
framework.
that. And I'm coming at this from the angle as one, it's just the right thing to do, but again, documenting, ensuring that you know you have a kind of robust kind of process in place. That's your get out of jail free card for if anything goes wrong. Okay, you know, because you can point to we
did our best. It's not that we didn't enter into this frivolously.
We did the best. We did the best.
We did the best.
Yes, because we have very high standard. You know, that was my point about just give everybody the same kind of disclosures that you'd give a retail client, even if they're professional or kind of a legible counterparty. Right? Give them don't just assume because they're big FTSE 100 that they know it. Right? Give them the same protection you give a 50 million turnover SME.
Yeah, I suppose this is where we kind of think about rules, and one of the questions that we get asked quite a lot, either as in-house when we were in-house and now as consultants, do we really have to do that? And because what you've just described, whilst it might be commercially sensible, it also sounds a bit expensive.
Yeah, I mean, well, it can be, but it doesn't have to be. Okay. Yeah, but that's where I can come in and help people.
Great, plug away.
As can
plug
you.
away.
As
yeah.
can you. And then 5. Let's think about and maybe this is number 5 because everything else is what you need to have in place before you actually do a trade.
Yeah.
Right. Number 5 is salesperson incentives.
Yeah.
You know, they need to be properly aligned to the risk.
Yeah.
And you know, I'm of the view that people should be paid when risk rolls off, which is not a bad thing in the world of FX because it's a shorter dated asset class. Bit of a pain if you're doing 15-year interest rate swaps.
Yeah.
But those actually aren't as risky. 15-year cross currency swaps, very risky. So getting proper incentives in place so that you align the salesperson's remuneration to the business kind of the business remuneration. So you're not cashing people out too quickly and then left with a lot of residual risks.
Yeah.
Of course, there's a competitive tension there because there'll be competitors who may offer, maybe a bit more generous and pay out quicker. But
So I think we've got an enormous amount of material. So thanks so much for giving so freely of your time. I've got kind of one more question, and I think so, Anna, we should probably kind of wrap up, I guess. So right at the start, I kind of asked you a question where you quite rightly came back to me and said, "Well, you're implying that something's wrong." Right. So now I'm going to, if you like, ask a question. In fact, I'm not even going to ask a question. I'm just going to say if the question I asked before implied that something's wrong, tell me what's right. Well, what do you think is actually, do you know what? What we do here in payments and FX, this just makes sense for everyone. You can pick one thing that you just say, look, this is fantastic about payments and FX. Kind of, what would you say?
I think there's so many providers out there. I mean, if you're FD of a small UK corporate, you probably get cold called or emailed every day by somebody, and I apologise to you all because of that. That's a function of the fact that there is a lot of provision, and because there's a lot of provision, there is a lot of competition.
A lot of competition, a lot of choice. I mean, that's on the surface, that's a good thing.
On the surface, that's a good thing, and there are a lot of really good quality people out there, not just in the bank space, but also in the non-bank space.
Yeah.
Many people who are running the non-bank space used to be at some of the largest banks. So, what a real positive from the sales side to say is that, look, it's a competitive space, so if you want to drive down and get value, you can. But what you can tap into, which if you're a small business, which could be really useful, is that there's some really good experienced people out there who, you might be able to sidebar about, other things, funding. Some of the non-bank FX providers can talk about funding now. You could talk about maybe if you're doing funding with your bank, you may be able to have a conversation about how you can hedge the interest rate risk with that on a standalone basis with a non-bank provider. Again, it brings in a bit more competition, it brings a bit more value, but you can now get some really, really good coverage from a broader range of providers.
This has been fantastic, Danny. I really, really enjoyed talking to you. Thanks so much for coming on. Are we gonna do myth or truth? Myth or truth with Danny Kinnear. You know, I get that.
Innovation and compliance are inherently at odds.
False.
Yeah, myth.
Myth. Innovation flows through everything.
The more data we have, the less judgment we use.
Again, myth. You always will apply judgment, but that judgment will hopefully be enriched by the data.
Independence matters more than influence.
I want to ask for clarification. Independence from what? What's the context?
So actually, the context is important here, isn't it? Yeah. So we're trying to get independence. It's like that independent second line function, and so
No conflicts of interest.
yeah, no conflicts of interest.
Oh,
It's that side of thing. We probably should have set that up, shouldn't we? Yeah.
So now that you have,
Yeah.
rerun the question.
Yeah.
Independence matters more than influence.
Myth, because having independence, having a kind of conflict-free decision maker is really good, but getting stuff done fast, there may be a bit more risk, but if it's justified, if the return compensates for that risk, then somebody with influence who can make it happen enables you to seize a commercial opportunity that otherwise may go elsewhere.
Yeah, absolutely. I mean, not that I'm being asked these questions, but I think influence is key. Getting things done in a commercially sensible way. Sorry, Anna, carry on.
Governance stifles growth.
Yes, true, but only in the short term. You know, good governance leads to healthy foundations, which hopefully you can have a more sustainable kind of healthy business.
And then the last one, you can automate compliance.
I think with what we've learned about ChatGPT and others, I think AI is going to do us all in for, so true.
Great. Thanks very much, Danny. It's been great.
Thank you.
Cheers.
Thank you. Always a pleasure.
Yeah. Thank
Until
you.
next time.
Yeah, that's right. And hopefully there'll be a quick next time, because we're going to try and see if we can get a bonus episode in.
Yeah. This is all fun. This is all
Great.
good.
Good. Right.
Good.
Thank you.